So I own over 2 million net rentable square feet of self-storage. What's happening today and how has it changed based upon my numbers? I'm gonna dive in and show you what's happened in the last 6 months, and I'm gonna give you some of these numbers so you can understand what's happening in the market. Allow you to kind of look behind the scenes, so to speak, to see performance. First thing, there's been a big change in self-storage. After years of downward rents, downward occupancy, storage got slammed. Rates dropped more than they did in the great financial crisis. 2025 was the bridge. This was the gap into a new market cycle. After years of downward, we had stabilization. Occupancy and rents finally stabilized in the year 2025. But the last 6 months, we've seen a big change. And there's reasons for that. First of all the excess demand when money was free and interest rates were cheap, that's all gone. And the market's rebalanced. Plus, supply has gone down tremendously, and it keeps going down. That's a structural change that increases demand. It's like a leverage point over time because supply takes years to come out. So by the time there's way more demand than there is supply, it still takes years for that supply to come out. That exaggerates the demands at that point of the cycle, just like it happens on the other end. When things are going good and lots of supply comes to the market, we see what we did over the past 4 years. Occupancy and rents go down as the market changed because demand changed. And the difference between 2025 and today has been wild. We've also been able to use AI and other technology to massively improve operations, streamline, and get better output. But out of net move-ins, meaning how many people moved in minus how many people moved out, we've had an over 800 unit swing in just the last 4 or 5 months. And that was during the slow season when there's less demand. So that's a big, big change. We also saw a big change on how people move in. The vast majority today are coming from online. They're renting online. That number has almost doubled since 2024. Plus, our conversion rates have gotten better. Our conversion rates are well over 10%, pushing 15+% on people that come in that actually convert to move-ins. More true core demand there. In fact, it was so big, we're talking about a 14x improvement over the last 2 years. And our cost per conversion is down by 62%. That's a huge change. Now, that has to do with multiple things. Higher conversion rate, we have less people that are giving away the farm to get renters in, and as more occupancy fills up, there is less bidding up online ads, so the price also lowers and goes down. And then because there's less options, renters are taking what they can get. Lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. They're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. We have them help us underwrite deals for our students and others. They are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class. It's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. Our return on ad spend is over 12x, a big improvement over the last 2 years. Occupancy at the same time moved up over 10% from 2025 to today. Our revenue monthly lifted by $90,000 to almost $100,000 a month from 25 to into 26. These are big changes of what we see happening in the market and how customers are reacting. It also shows a big change in how they are utilizing storage as well as what options they have. And this is a trend that will continue. Why? Because the lack of supply, and the supply pipeline is still going down. It's not going up. So 2025 was the bridge, and 2026 we're seeing the turnaround, and we're seeing it in fundamental numbers of how customers are reacting, how many options tenants have, and how many options customers have. This also shows the massive improvements in online strategies and what's going on there. The implementation of AI. We've cut down over 100 man-hours a month in customer service replaced with AI. That's not a small difference. That's a massive difference, considering it's pennies for AI to do it, where you have to pay somebody $25 or maybe more an hour to do that customer service. We've also seen a big change away from call centers moving to AI for these reasons, and the output is better. Good reviews are up, bad reviews are down, not just on our portfolio, but on assets across over 30 states that we're looking at and analyzing. And this is all good news, especially for people starting out. The tide has changed, demand, occupancy, rents are going in the opposite direction after stabilizing, and we have technology that helps you operate more efficiently at a lower cost. That's a big advantage to the small and medium investors who aren't the big REITs. A lot of it comes to the connectivity of the online process, meaning someone goes to rent online and actually finalizing that rental agreement on their phone. Marketing tied into your property management system, customer service, and sales have been condensed. It shortens the time frame that it takes for a tenant to look for a facility and to rent, making your conversion rate rise and making it cheaper. I'm going to keep updating you on what we're seeing, especially now because we're moving into the busy season. So this was a snapshot of the change from 25 to 26 in the slow season. Now, the question is, will this continue? And a lot of it is going to be driven by interest rates as interest rates change demand in the market. Interest rates dropping for 30-year mortgages below 6% is a big deal and will have a very noticeable change in self-storage demand. Now, we don't expect that to happen anytime soon, but over the next 2-3 years, that will keep going down. And we could see interest rates at 5.5, which for self-storage, that's a totally different market. So make sure you like and subscribe, and we'll keep you updated. Also, let me know what questions you guys have in the comments so we can make more videos and tell you what's going on.